Ladies and gentlemen, thank you for joining us today. Welcome to the Fundrise Innovation Fund's first ever Investor Day. Now, please join me in giving a warm welcome to Fundrise CEO and co-founder, Ben Miller.
Oh man, well, it's pretty wild for me. Thanks everyone for coming. I never imagined I'd be on a stage like this talking about what we've done, what we're going to do. It's really just like I feel so privileged and lucky that I'm here because the team is so incredible. Fundrise team has been. I don't know how I could have gotten through any of this without them. I know I couldn't have. So, anyways. Before I get into the presentation, I thought it'd be helpful to give people just some background, because the reason we're doing everything we're doing and what we're trying to do next is it all starts with where we came from in 2008. Like 2008 was the great financial crisis. I was working in real estate. I had a big capital partners, and the world just blew up. I mean, it's hard for people who weren't really there to appreciate where, all of a sudden people were like, is my money in the bank just going to disappear? Like literally every bank was on the verge of going bankrupt. The biggest banks in the world, the bigger you were, the more risky you were actually. Like I had a partner who had almost $500 billion in assets, and they went bankrupt. Like I was the big guy all of a sudden. I mean, it just totally turned my thinking upside down. And I came out of the experience very skeptical of financial system, institutions. Just because you're big doesn't mean you're smart or safe or honest. And so I started to imagine, like, could we build a better way? Is there another way to go about, like, giving people real assets to own? Like, could people have something that's just outside the system? There's actually kind of a very similar ethos is what happened with crypto, where people wanted something that was like not part of the system, and we just did it with real assets. And so it started us on a journey where I went out and talked to 11 law firms. Like, is there a way to democratize investing into real things, real estate, real assets? And I finally got an introduction to the biggest law firm in New York, in the top, like securities attorney, the top real estate people, the top. We went to the top of a skyscraper in New York, Condé Nast building, and this is 2011. And I tell them, like, we got to democratize investing, we got to build a new system, system's broken, like imagine if we could build a new way. And I thought I just nailed it, right? I was like, this is amazing, right? People are gonna be so excited to help me because this has never been done before. At the end of the whole thing, I remember the sun setting. Like there's a whole, like, behind them was this like panorama of all these buildings in New York with the sun setting behind it. And then he looks at me and he says, why would you bother with a little guy? Like, why bother with a little guy? And it was like the last thing I was expecting to get from him. I literally thought he was going to be like, that's amazing, that's genius, just let's go change the world. And instead he's like, who cares? And at first I was like shocked, and then I was like angry, like incensed. And so I said, like, well, because they're getting screwed. And he said, that's your opinion. And it was funny, back then Occupy Wall Street was literally like protesting out front of their building. Like, it's my opinion. So anyways, that is when we started this mission to build a better financial system for the individual investor. Like, most people don't necessarily know this, but the financial system is designed for institutions. Like, institutions are what move Wall Street. That's where the money is. That's how the system is built. And it's partly because a lot of people, if you're going to have people involved, you need to have scale. And so institutions run the system. And we said, well, why can't we build something for people, for individuals? And the challenge was there was a regulatory barrier. There was like, no one's ever done it before. There was all this technology we had to build. And so in 2012, we were the first company ever to take up real estate property and put it on the internet. This is before the Jobs Act. When we started the process, people thought we were crazy. We literally, like, people just thought that was hilarious, that we were gonna take a building and let anybody invest at $100 a share. And it was not easy. It was hard. But we've always wanted to democratize markets. We always wanted to basically sort of turn the system upside down, open it back up. And pretty much everything we ever did, people always told us we were wrong in the beginning. I always say it started as crazy, then became novel, then became obvious. That's always how all of our innovations have gone. In 2015, we moved to a new model, which was we call it an E-REIT. It's an online real estate investment trust. We democratized investing into private equity, real estate private equity. Again, at the time, a lot of people thought we're critical. A lot of people told us it was a bad idea. Actually, we lost half our customers in that transition. Half our customers were like, no, I like investing in individual deals. And I thought it was too risky. That was 2015, so we transitioned to a platform approach, a diversified managed portfolio. So fast forward to 2021, we had successfully democratized real estate. We really had done it. It was crazy. Like, I never imagined 2012 that we would be so successful. And we said, well, what's the next hill to climb? And we said, let's try to democratize investing into private tech companies. And no one had ever done that before. There's no such thing as a public venture capital fund. And so we went to the SEC. It took a couple of years. And we were the first to file a public venture fund. And so that's called the Innovation Fund. And so we've now really gotten to a place of scale that is just, it's just crazy. Even my mom is a little bit impressed. And so we have 2 million users. Our fintech platform serves people, all the time. We have a massive engineering team. We have billions in equity under management, hundreds of people. We own and manage tens of thousands of residential units. And then my proudest of all our facts, we've cleared 120 public offerings. That is a lot of work with the regulators, and so we have some sense of how to innovate in this world. And so we built the largest direct-to-consumer alternatives platform in the country. Now, what's interesting is that all through this period, the problem we were trying to solve got worse, way worse, like crazy. Like, you see there's this inflection point around 2020 where it just goes exponential, and the size of the private markets now rivals the size of the public markets. Like, that's crazy. Like, actually last year, more money was raised for tech companies in the private markets than the public markets. So you're talking about this total systemic change of how wealth gets distributed or ownership gets distributed in America. And so when we started, we knew there was a problem. We have succeeded in some ways, but the problem underneath of us just got a lot more extreme. Probably most people know this, but the reason why the private market has gotten so big is that companies don't want to go public anymore. So the number of public companies in the US has been falling for years. So there's not just one company. Everybody says, what about OpenAI or SpaceX? It's thousands of companies have stopped going public, right? Country's gotten a lot bigger. There's a lot more people, a lot more GDP. That number should be going up, not down. And there's a lot of reasons for it. One is that obviously the regulatory burden is high. Two, if you're building a company like we have, that it doesn't always go well the first time. You have setbacks. So if you're building in the public markets, there's all sorts of people attacking you, hedge funds, short sellers, lots and lots of critics online. And so companies have said, well, what's the point of that if I can stay private, raise the money we need? And so companies are staying private longer. I want to give you some examples here. So Amazon went public 3 years into its life. Can you imagine a company today 3 years into its life going public? No way. When they went public, they were a $438 million IPO. They were worth $438 million when they go public. Now they're worth $2.2 trillion. So that's $2.2 trillion of wealth creation in people's 401ks. That's the public benefited from the change. Amazon drove a lot of change, right? Retail, a lot of retail, there was a lot of change in society, but that change was okay because we all participated in success. So that's Amazon. You fast forward to Meta, Facebook at the time. Facebook goes public 8 years into its life. Back then in 2012, like 8 years seemed like a long time. Like that's an old company back then. And they had IPO'd at a $100 billion valuation, and now they're 1.7 trillion. So they created $1.6 trillion of wealth for everybody, right, in people's public brokerage accounts. 93% of its value captured by the public. Uber, 10 years. It was a 10-year-old company when it goes public. This is 2019, and since then, it's been successful. About half of its value was captured in the public markets, half was captured in the private markets before it went public. So you get the trend here, right? SpaceX, look at this. So SpaceX is talking about going public this year at 1.25, maybe 1.5 trillion dollar valuation. So that's $1 trillion of value created in the private markets rather than the public markets. And it makes sense to me why that happened. Like if anybody followed Tesla, when Tesla went public at a $1.7 billion valuation. I think now it's 1.7 trillion. And the public markets almost bankrupted Tesla like 3 times. There was like short sellers, there was a tax. Like if I'm the CEO of Tesla, he's somewhat well known, you would say, well, I'm not going to do that again. I'm going to stay private because I don't want to risk getting blown up by the volatility of the public markets. So it totally makes sense why SpaceX hasn't gone public yet. The downside, the unintended downside was all this wealth creation not captured by normal people, normal investors like us. So there's a problem, right? The problem is you have public investors and you have private companies, and there's this wall between them that's separating or dividing us, dividing basically wealth creation, who gets to be part of this change. And this problem has been growing as private companies stay private longer, and there's been a lot of technology change we'll talk about in a minute that has made this problem more acute. Okay, so what are we going to do about it, right? So I have heard a bunch of different ideas. One of them is force the companies to go public. So anybody who's on X, Twitter, this morning I was reading a tweet by Nate Silver, who's this famous, pollster, and he said, we should force OpenAI and Anthropic to go public ASAP. Like they're so important, they're so critical, their market cap is almost their own category. And so, anybody here, the idea that you'd be forced to go public seems like not the solution you'd want. Maybe it works once, but it's not a systemic solution. So that's the kind of ideas you've heard. People are frustrated. What you're really hearing is frustration, right? Okay, another idea is let's deregulate the private markets. Right? Let's just let 1,000 flowers bloom, let people invest. Let's lower the regulatory burden. And there's a lot about that I think makes sense in theory, but in practice, that is not how the private markets work. So most people don't invest much in the private markets, probably never worked for a venture fund or raised money for venture funds. But if you are a company and you're going to raise $5 million, $20 million, you want to raise it from one person. You want to raise it from a venture fund. You don't want to have thousands of investors. You're not trying to have a huge investor relations team. You don't want thousands of people asking you for investor updates every other week. That's why you're private. So the idea that you would deregulate the private markets and then get into these great private companies doesn't make sense. Also, these best private companies, everybody wants to invest in them. Everybody. And so like when we invest in them, you have to have millions, tens of millions, sometimes hundreds of millions of dollars per check. And you have to have relationships, you have to have reputation, they have to know you. They want to have people who are helping them They want to have like value-add investors. They want to be focused on their business. So the idea of like just deregulating the private markets, it doesn't make sense. It doesn't actually, even if you did, you were not going to get into these best tech companies. That's just not how it's going to play out. So, okay, so what are we going to do? Like, there's a problem. There's clearly a problem. Like, everybody knows it, right? You need to figure out a bridge between the public and private markets, between these two great, important assets of America. We need to figure out how to get the benefits of the public markets and have how it works in the private markets, right? So, okay, here we go, the great unveiling. So that's what we're here today to announce VCX. So VCX, yes. Oh, that wasn't me. VCX. So VCX is a bridge between the public and private markets. It's meant to take the best of the public markets and the best of the private markets and create a solution that works for both sides. I think it's the future of finance. And people, if you go look at the history of finance, like there's always new inventions in finance that create new categories and make new things possible. And I think looking a little bit back at history helps people understand why this makes so much sense. So over the last 100 years, the arc of finance has bent towards democracy. We've seen more and more people have access, and more people are owners in our society. More shareholders, more 401ks. Like this is a huge mega trend that's been going on, since before the invention of the stock market. And it's been made possible by people who innovated. So Fidelity was one of the first inventors of this sort of scale mutual fund. And people take mutual funds for granted, but they were an innovation back in 1947, I think, right? The idea of, okay, I don't know how to pick stocks. I don't know how to invest in the stock market. It's probably an insider's game. Let me just give it to a really good company who knows how to run this for me, have great performance. And Fidelity had transformed who got the benefit from the growth of America, from the stock market. Vanguard, famously, right? Passive index, John Bogle. He created this idea of passive investing. Wow, you can see this massive growth in the number of investors participating. And every single time these companies innovated, not only did they expand access, they lowered the cost of innovation. The cost of finance. Fees came down, spreads tightened. Innovation and lowering costs have always gone together in the history of finance. And so, see, it was Spider with ETFs, the invention of the ETFs, iShares and Invesco with QQQ, right? These are all actually, interestingly, like slight innovations on a 1940 Act investment company. They're like a mutual fund. You just create a new use of a regulatory wrapper to solve a problem that at the time was important. So we think we're creating a new category here. You see it's very small below the word VCX. We think it's called public venture capital, PVCs. I'm trying to own that. PVCs. I hope someday somebody says PVCs and has no idea where it came from. And so a public venture capital fund is an innovation. VCX will be, among the first. Maybe we were the first, and that's going to create essentially this bridge that we need to have. And you might be surprised to find out that when we told people about this idea, we got some critics. That never happens to us, doing something new and hearing critics. And everybody in America loves change so much. So let me give you some of the critiques we heard. So social media is really good at criticizing things. And so one of the critiques we heard was, it's a higher fee than public ETFs, public funds, right? Oh my goodness, VCX is going to have higher fees than like a mutual fund or an ETF. We heard that on social media. We heard it's going to hold illiquid private companies, right? Most ETFs and mutual funds, they hold public stock, right? They hold liquid companies. So that's very different. There's less transparency. Like the private markets are less transparent. The companies that are public today like Google. They do financial reporting. They're regulated by the SEC. There's audits. There are a lot of the private companies, although they're actually audited, they don't have to report that to the public. So there's a big difference there. And lastly, public companies are pricing every day in the stock market, and private companies are pricing usually when there's a venture round. Whenever the company raises money, once a year, once every other year, that's when they get priced, and it's very different. Now, I would argue public markets aren't that perfect at pricing things. Sometimes they get it wrong. But these are the kind of critiques we got of VCX. And what's funny about this is that these critiques are true for all venture funds. Like every venture fund charges higher fees than an ETF, right? Every venture fund holds illiquid private companies. Every venture fund is less transparent than they own company stock in private assets that there's a lot less transparency than the public markets, right? It's private, not public. And it's much harder to price a private company. So venture capital is bad. It shouldn't exist, or it's too expensive. But what you're not criticizing VCX, you're criticizing the entire industry. And what's fun about that industry is actually it's pretty successful. Like VC, venture capital, is one of the best performing asset classes ever. It's really good at building companies and having pretty good returns. And so you can debate whether or not people should have access to it, but I believe that should be a decision of the people, not something that they're prohibited from, banned from doing. And it's just funny, people can invest in esoteric derivatives, on their brokerage account, but they can't actually take their capital and flow that money to build the next generation of technology, of biotech. If you want to change the world, you want to fund these private companies, yet it wasn't possible, and that just doesn't make sense. It should be possible. Okay, so I want to do a side-by-side comparison between venture capital, traditional, conventional, old-fashioned venture capital, and public venture capital, PVCs, right? Because there's big differences. You might say innovation. So, okay, right? They both invest in private tech companies, right? That's the knock. It's a private tech, but that's the whole point of venture capital and public venture capital. The second is they're both professionally managed, right? You have people who hopefully know what they're doing. They're analyzing the companies. They're negotiating with the companies. It's a very hands-on activity. You need people who have professional experience with tech, with finance. Venture capitalists can be active managers. I've had my share of raising venture money, investing in venture, working with venture. They add value or they add activity. It can range. The public venture capital fund wants to be a passive investor. It's under the regulations of a 1940 Act fund. You really can't have control and be active the way you are in a private venture fund. So it's much more passive, long-term, I think ideal capital, because what the founder wants to do, what the team that's building the thing wants to take a long view, wants to focus on building something that makes more sense 3 to 5 years from now, not every quarter. And even venture funds, as much as they're really good at funding innovation, they cycle their capital. They take their capital and they reinvest it. So they actually are focused on an exit in a way that the long-term public markets have a perpetual long-term focus. It's a big difference. This is the biggest difference, though, right? Because venture capital funds, private venture capital funds, when you invest in them, you're locked up typically for 7, 10, 12 years. Totally illiquid. How many people here could take a lot of their money and invest it and say, okay, I hope I get it back in 2038, right? Who thinks about 2038 right now? Not me, right? So that's That's such a big difference. And so PVCs are going to be liquid daily liquidity. I think this is a revolution. Like, I think this is going to be huge for the companies and for the investors. I think this is going to actually have enormous benefits for the country as we actually probably bring more capital to bear, building great technology. I think this is going to disrupt venture capital even, which is like a side benefit. Private venture funds typically don't have, public reporting. That means you file things with the SEC, you file things on EDGAR, you file publicly, you can see all of their information. But public VC is highly regulated. We're highly regulated. We are 40 Act, our fund is a 1940 Act registered investment company. That means we have a lot of compliance, a lot of regs. In a way, what happens is the PVC, takes on the regulatory burden, so the private company doesn't have to, right? That's the point of the bridge, right? And lastly, cost structure. So people who don't invest in venture capital probably don't know, but you typically pay 2% annual asset management fee and 20 to 30% of the profits. So if you invested $100,000 and 10 years later you had $200,000, you'd give 20% of that to the venture fund. So this big share of the upside is paid to the venture fund for doing a lot more work. Because you think about it, right? If you wanted to buy stock in Google today, Meta, you just push a button. You don't have to show up and like get access to these private companies. I mean, it is such a different job. So it makes sense that they would be paid more than public funds. But the public venture capital fund is a flat fee. There's no carried interest, no profit sharing. So this is very different. So I think it's possible, not only is PVCs, public venture funds, public venture capital, really good for like investors, but it could really be good for the whole market. Some competitive pressure on economics. Okay, so PVCs make sense, but what about Fundrise? Our innovation fund is invested in some of the most important companies in the world. Right? Everybody says, fine, maybe I believe PVCs are going to be, awesome, but are you going to be a good venture investor? And when we started the innovation fund, social media was critical. I mean, again, it's surprising, but people on Reddit were skeptical. Now you look at this. I mean, clearly some of the most important companies in the world, certainly the most important companies in the private markets. Most of these companies, maybe every one of these companies, oh no, there's one. They're billion-dollar, multi-billion-dollar, $100 billion, trillion-dollar companies. Huge companies, right? Huge. 20 years ago, they would have been public. Like, we wouldn't need to create a PVC. But now they're private. So we have to address this problem. And then when I show this to like venture people or other tech people, they tell me, well, how on earth did this happen? Like, how did you know? How did you identify these companies? And so I thought I'd show you our track record of how and when we invested in these companies. Because people usually, they literally don't believe me. They're like, who are you? You're not some fancy, Silicon Valley, Sand Hill Road investor. How do you get access? How did you know? And, we're different. And so what's different about us, right, is we have a fintech platform. We have incredible software engineers. We have a 100-person tech team. We also have a 100-person investment team. And that combination is a new kind of DNA. And so, Vanta, we invested in their Series B. We're a customer of Vanta. Databricks, we're a customer of Databricks. Anthropic, we're a customer of Anthropic. Like, we created, I think, another thing we did is we created something called Real AI, which is the dominant real estate AI platform. And when we were building Real AI, we recognized that Anthropic was a killer business, like unbelievable. It's only gotten better. And we're like, we have to invest in them. We invested in them and we tied it up in summer of 2023. Like, that was super early. Canva, Anduril, we've done a pretty good job. And it's because we had conviction based on knowing what the tech is, being in the market. So we're really closer to the ground than most people. And so we get the conviction. And then the other thing we do is we concentrate our conviction. Like, I think one of the rarest things in the world is actually having conviction. Like, I always tell my kids, the most important thing in life is to know what you want. And most people just don't know what they want. And that's probably why passive investing works so well. But it doesn't work as well in the private markets. Private markets are very inefficient. You really have to know what you're doing. That's why you need professional management. Our biggest investment, our biggest holding is Anthropic. Like, if anybody reads the Wall Street Journal these days, Anthropic is completely changing the software industry. Cloud code, I mean, it's remarkable. And I think in the last 2 weeks, they've wiped out $1.5 trillion of value out of the stock market because their software is so transformative. So if you look at it, the top 3 companies are almost 50% of our portfolio. Super, super concentrated, super, super focused. AI probably makes up 60 to 70% of our portfolio. Like, we really have a strong opinion about how to do this. And our historical performance, what you're seeing is the outcome of owning these incredible portfolio companies. This is good. I mean, for my legal compliance team, past performance is not indicative of future results, right? But when you own great companies, you can have a lot of confidence that they're going to continue to innovate and continue to drive growth. I mean, the growth you're seeing at AI companies, unprecedented. You've never seen companies grow this fast. And so I'm really, really excited and confident about the future of what's happening. And so let me just go a little bit deeper here, because there's really the biggest difference about us, right? What's so different about us? That was not a normal venture fund that had 50, 100 really wealthy institutions and individuals who made that money, made those returns. We have 100,000 plus investors in our innovation fund. Like that, I think that's never happened before. So we democratized that success. Like, these companies who are building these incredible technologies actually did spread their success through our venture fund. And that's why VCX is so important. We got to scale that to more people, make that more normal. And the other point I want to make out is our fee. Our fee must be the lowest I've ever heard in venture capital. Way, way, way lower. So lower fees, more investors. Like, this is what we're all about. So I'm going to start to sort of wind this up, but the why now, I think, is also critical. Like, why now? Because AI is at the cusp of an amount of change that I think we never could have imagined. I never imagined. It could reshape all of society. And so there's been other venture capital waves, other tech waves, PC, internet, mobile, cloud, but nothing like AI. AI is totally different. The scale is, I mean, if you listen to these AI companies, they're talking about the potential of having $1 trillion in revenue. I mean, they're growing at rates that we've never seen before. And so the question actually is, who gets to own this? Because you're talking about tens, maybe hundreds of trillions of dollars. Like, the two paths we have in front of us have never been more stark. Are we going to have a path where the economics are shared among many, or among the few? Right? Like, it's possible that if we had an exponential moment, that not only is this about your future, but it's also your children's future. Like, a lot of people in Silicon Valley talk about this problem. They're really worried about it. Like, outside of Silicon Valley, people are more skeptical of AI. But if you talk to people at these companies and you work with it, like, they're really worried about this problem, about redistribution, making sure that the society we live in is a fair society. And the kind of solutions they talk about often is something called UBI, Universal Basic Income. So I call that redistribute the income redistribution. And that's like, it's an idea, but I'd much rather have ownership redistribution where the ownership is fairly shared, because this is an ownership society. It's always what America's been about. So, we're launching VCX. We call it the public ticker for private tech. 15 years ago, when we came up with this idea, we never imagined that the problem we would be solving is so much bigger than we ever set out to solve. I used to go see movies about artificial intelligence, right? That's crazy. We're actually talking about artificially intelligent agents doing work that people used to do. It's going to have a huge effect on all white collar work. It's definitely going to happen. How it's distributed, how it's owned has never been more important. When we started out, we thought this was about reforming, building a better financial system. But this is potentially about the whole system, way more than just about money. So I'm here to announce the launching of VCX, and I'm super excited about what it could do for our investors and for everybody. So onward. Okay, not done. So we have a lot of investors, 100,000 investors. So you imagine we probably had 500,000 questions. If anybody knows our team, Kendall and our IR team, it's crazy that we're able to manage so many people. So we have questions. And so we tried to take and distill down the short list of questions people had, because they're really important questions that we need to answer. So the first question was, a concern we got from investors was, how does listing VCX change the investment strategy, right? We have this, what they have had is a really good performing fund. The strategy, the portfolio has been excellent. And so people are worried, oh, you're going to list this thing, you're going to change it, you're just going to become something different. And that's, people don't love change. So I want to say two important things. So one is the short answer is not going to change, right? The strategy is to invest in the best companies. And the second thing is that what we're talking about doing is what we've already been doing, right? For the last 3 years, 100,000 people have invested hundreds of millions of dollars, and we raised that money and we invested in top private tech companies. And they invest that money at NAV, so that's the net asset value. They invested at the value of the fund. So we've always been raising and deploying. And so if we go public, it's possible that just continues. So there's very little change to the strategy and the operations. And the goal is to continue to focus on the best companies. When we invested in these companies years ago, 2-3 years ago, they were not on this list usually. We were there before. I got some grief from a reporter that said, oh, you're cherry picking from our list. I was like, no, we were there first. So goal is to democratize access to the best companies. That's our goal, that's our mission, that's what we're focused on. And I think we can continue to do it. And I think listing the fund will make it more possible, more credible, bigger reputation. And the companies want to have really good counterparties, right? They want to have a fund that invests on their cap table that they like and trust and know can be there in good times and bad. I've been a founder, I've been a builder, I arguably still am. Things do not always go up. And I know it's important to be there when things go bad. That's when you see who's a good partner. Okay, next question. So some people who know about finance have asked a question about how VCX is different from a listed closed-end fund. So a listed closed-end fund is very different than what we're talking about doing. So the regulatory wrapper may be similar, but the assets, the strategy, and the operations are totally different. The job I do is nothing like a closed-end venture fund, a closed-end traditional fund. So typically, a closed-ended listed fund holds public stock, public bonds. Like I did some research. Most commonly held assets are Microsoft, Apple, Amazon, Alphabet, NVIDIA, Meta, right? That's Mag 7. Right? You don't need a professional manager to pick your Mag 7 and pay them a high fee. So it's a more expensive wrapper than just doing an ETF or buying it direct. And so it trades frequently, and actually typically, I think closed-end funds, I think like 90% of them or more trade at a discount. And it's possible when we list, we trade at a discount. But I think that the business of PVCs, the business of public venture capital, is nothing like a traditional listed closed-end fund. You're talking about access to SpaceX, OpenAI, Databricks, Anthropic, Anduril, Ramp, and the next great private companies. So it's a very different asset. I think it'll trade very differently. Nobody knows. Nobody knows. And the regulator wants me to make sure I give you a balanced point of view. So I'm hoping I'm balanced here. But I think that to compare it to a closed-end listed fund is, I think, going to be wrong. But it's the only point of departure. So it makes sense you'd ask that question. Okay, another point of departure, another like comparison people say, how is VCX different from an ETF? Like anybody knows QQQ, which basically tracks the top tech companies in the public markets. Okay, that's how they're different. So the portfolio companies in QQQ, mostly Mag 7, heavily weighted towards the biggest companies, are growing at about a weighted average growth rate of 25% a year. And that's actually like mostly because of a few companies. The portfolio companies inside VCX are growing way faster, like way faster. And that's because they're younger, right? When does growth happen? When you're young. Like I have kids, they're growing a lot faster than me. And public markets are about stewardship, conservativeness, wearing suits. It's a slower, maybe safer, older crowd. And so they just have these differences. And I'm not saying one's better or worse. I'm just saying it makes sense that people should have access to both. And then for people who are more of the financial types, here are some like more granular data points. So in 2025, the portfolio companies inside VCX grew 7 times faster than QQQ, companies inside QQQ. You pay a higher multiple for that. The growth, the revenue multiple on a weighted average basis, right, is higher for the private companies than public companies. But the growth is also way higher. And so you're getting twice the growth, 7 times the growth at half the price. So from I call it price per growth. It's something that like not a lot of people like talk about in finance, like in public markets, because they actually don't. There's not a lot of growth in public markets. No one's growing 193% in public markets. So this price per growth is like really important metric as you think about investing in high growth companies. So the point is, ETFs, QQQ, the work of investing in those companies, the kind of companies, the kind of growth are just super different, super different. Okay, I have one more set of questions. I just want to actually say one other thing. I just feel like I meant to say it when we're talking about this sort of like, these stocks, to get into these great companies, it's so hard. There's a limited amount. There's an infinite amount of stock available in the public markets because you can just buy it from someone else. But in the private markets, it's just so limited, so difficult to get. That's really one of the hardest things I have to do. Anyways, okay. We have 100,000 investors. We're talking about going public, listing the fund. So one of the frequent questions is, how do I get my shares? Right? So most people have never invested pre-IPO. Like they don't invest in private companies. Most people don't work at a private company, so never seen their shares move to the public markets. So the way it works is you have 100 shares of Innovation Fund. We go public, you still own 100 shares of Innovation Fund, right? All it is those shares now move from the Fundrise account to your brokerage account, and you can trade them. Hopefully, you don't trade them, but you can. The way you get your shares is you can ask your broker to pull them, or you go to our transfer agent. So all the shares are held by this sort of record holder called a transfer agent, and you can go to them. They're called ComputerShare. They've been our transfer agent for about 15 years, I think. And you can ask ComputerShare to push the shares to your brokerage account. So there's a logistical work here. We're going to email you. We're going to tell you how to do it. I'm sure you'll have questions. We're here to help. But this process is going to be, a little bit grindy because it's not really meant for 100,000 people. And lastly, when are we going to list? That's a good question. We're working on it. New York Stock Exchange on calls with us today. I'm hoping second week of March. You don't really know. Always something can intervene. You want to go public when the public markets are hot, warm. You don't want to go if in a bad environment. So there's some tactical work here about doing it in the right moment. But I feel like hopefully mid-March. So okay. So wrapping up here. I want to thank everybody for coming. I mean, it's so wild to me that we get to be doing this. It's been, now I'm practicing my life's work, 15 years. Our team does a lot of stuff. You probably know this, but our team builds software. Our team does a lot of finance, a lot of investment, and does a lot of real estate. But also, we're pretty good at making videos, it turns out. I had no idea. So we have a kind of a mission statement, a value statement about what we're trying to do, and we turned it into a video. And I want to share it with everybody because it's so freaking awesome. It's crazy how good it is. So anyways, onward.
It was the stock market that started history's greatest wave of wealth creation. From factory workers in Detroit to farmers in Omaha, anyone could own a piece of the great American companies. But today, our most innovative companies are staying private longer, which means everyday Americans are missing out. Until now. Introducing VCX, the public ticker for private tech.